Hi, Matt McAleer, Director of Equity Strategies, here in the Cumberland Trading Room just after the close on February 22nd. Not a lot of activity from a buying and selling standpoint in our equity portfolios this week. We like what we own. We had good upward pressure on those prices, so we stuck with them. We're at a juncture in the market where we're starting to approach that 2,800, which was an important level back in October and into the real weakness in December. So that may be something to really watch next week. Last week we talked a little bit about the S&P 500 versus the Spider Mid-Cap 400 and those two indexes and how they fared over a 1, a 5, a 10, and a 20-year period. We also touched briefly on growth versus value, and I wanted to share some thoughts there. Remember, we're believers in the fact that asset class style and asset class size are a big input to your performance. And we've been leaning growth in our equity strategies for a few years now. We started going halfway through 18, we started getting a little bit of a value tilt. We're still predominantly growth, about 60% growth versus 40% value, but that value is a larger part. Why have we been growth, and why are we starting to lean against it a little bit? Well, 1 year, SPY-G, the S&P 500 growth companies, outperforming SPY-V, S&P Value Index, by about 5%. When we stretch out to 5 years, 30% total return outperformance, growth versus value. We stretch it out to 10 years, 130% outperformance, S&P growth versus S&P value. You can take a look at those with SPY-G versus SPY-V on your Bloomberg or Google or any of the different engines you like to use. In terms of getting that right versus a broad index such as the S&P 500, we don't want to outthink it. We want to keep a ratio in terms of where we think the performance is, and we use relative strength to try to indicate to us which area is outperforming. And although SPY-V value showed a little pickup late summer into October, now that we've hit January, growth is taken back over. So we'll be keeping a close eye on that ratio in the coming weeks. As you know, we've been talking about technology, led by semiconductors, still the strongest area to be. We've had a nice pickup in energy. As you recall, last year, late in the fourth quarter, we were underwater on energy. It was a real drag on performance. Although it was only a 8% position in our US ETF, the downward velocity was causing a lot of trouble. We've come out of that a bit. Now we'll see if any of these higher lows in XOP in our energy holding can continue pushing it further. Bond land, kind of a quiet week in bonds. 10 years stayed in a range, 265 to 270. We'll be keeping an eye on that right now in a duration level, which is a risk measurement for our bond portfolios. We're at about a 3.9 in our taxable portfolios and about a 4.5 in our munis. So we respect the fact that rates can go higher, but we don't want to give up those higher coupons that we're finding on the muni side in relation to taxable. Quick note there, if we go out to the 30-year Treasury at about 3% and compare it to what we see in a similar muni bond out 25, 30 years, we're seeing about an 80 basis point pickup in munis. That's not even factoring in the taxable equivalent yield, which jumps it higher. So we're still finding value in the muni space. Everyone have a great weekend. We'll be back with you next Friday. Thank you.